Kitco Mining special coverage of BMO's 33rd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.
Will the gold and copper equities break out? This is Paul Harris of Kitco Mining at the BMO Metals, Mining and Critical Minerals Conference in Hollywood, Florida in the USA. And joining me today to talk about this is Colin Hamilton, commodities analyst for BMO Capital Markets.
Hi there, Bob.
Colin,
Hi.
welcome back to Kitco.
Thank you so much. Good to be here.
A great event this year, some 2,000 people. I think it's one of the highest attendances you've ever had. But the question is, are they here for gold, copper or critical minerals?
I think they're here for everything. I mean, this conference, it covers the entire market cap spectrum. It covers all these commodities. For me as an analyst, it's great. I get to see many companies talking about many different things. So I think they're here for gold and copper, and I think copper is probably more in favour, judging by our polling questions. And the critical minerals we've added, it's interesting. Much more volatile markets this year, though.
Okay, we're going to dig into a lot of those points through this conversation. The setup for gold and copper looks very positive, with the strong tailwinds there forming. What excites you most about the prospects for the red and yellow metals and the companies that produce them?
Okay, so let's start with copper. The raw material end of the copper market has tightened dramatically this year. We've taken almost 1 million tonnes of mine supply out our model in the past 3 months. So you look at where treatment and refining charges are now, and that's telling you that raw material end is tightening up, and that will flow through to the refined market. The supply problems we've had this year, we're used to supply problems in copper, but they have been extreme in terms of the assets taken offline. So in terms of copper, yes, we would be expecting a higher price. Now gold, it's interesting, I keep saying it, gold is the one commodity in a super cycle. It keeps the annual average record again last year, and we're seeing it trade consistently above $2,000 an ounce now. What I think is interesting is what's driving gold has changed a bit. Central banks we know are in there, consistent buyers, but also in the Chinese market, we're seeing a lot of households come into gold because the equity market's bad and the property market's bad. And gold is a safer place to go and put your assets.
Okay, let's unpack that first with the copper. BHP recently shared its outlooks for copper. We've painted almost a doomsday scenario in as much of a lack of investment, increasing sustaining capex. And it said the price and marginal ton a decade into the future is going to come from sources that would not likely come cheaply or easily. Are we returning to a situation like we had in the super cycle 15 years ago, where the copper price, well, copper is poised to really take an exponential growth?
I think one of the interesting things here is that the price, and we heard it from a couple of companies already presenting today, from Glencore, from Freeport, saying, look, today's copper price doesn't incentivize us to go and build the assets we would need to do to grow. So we have options, but today's price really doesn't cut it in terms of what we need. So what we're seeing is this lack of investment. It's a little bit conservative, but it's saying, well, it's hard to be able to justify that spending right here, right now. We like the demand story, but actually we'll just wait and see when the growth comes through. So I do think we're certainly risking underinvestment in that side.
The copper price is what, $8,000-9,000 per tonne. You have people like Robert Friedland saying the incentive price for him is, say, $15,000 per tonne. As an analyst, what kind of price do you use in your modelling as an incentive price, and how close or far is that from what you're hearing from some of the speakers here?
Yes, and from the speakers, they're saying, look, we need north of $4 a pound, so north of $8,800 a tonne, and potentially much higher. What I would say, incentive pricing almost isn't working. We're not, by its nature, implies an elasticity of decision making to price, and I don't think we're seeing that. And therefore, actually, the risk for the industry is that the fuel to materials transition is a once-in-a-generation opportunity to see growth for this industry and see investment come through. And by not investing, well, what happens? We're great engineers in the world. We will design ways around this that are maybe less metals intensive if the supply isn't there. So I think there is a risk that the mining industry, by being a little bit conservative, is going to miss out on this, let's say, generational opportunity.
I don't disagree with you, Colin, but you avoided my question. Yeah. In your modelling, in your forecast.
Our long-run through-cycle price is around that $9,000 per tonne mark. Okay. In today's money.
And do you think that needs, realistically, it needs to be higher for some of these companies?
I wrote in my outlook piece for this year, I said, look, the trend is still for long-run commodity prices to be trending higher. And it's interesting, you see the capital cost inflation that we've seen in a number of operations, and you look at it and you factor that in. I think, yes, the long-run pricing is still on an upward trend. We've seen now, by the way, for the base metals, the average long-run price has gone up by about 20% over the past 3 years.
I think we're coming out of or we're certainly in a part of the cycle where company managements are very sort of risk-off in terms of making new investments, particularly large-scale new investments. And reflecting on Tech Resources QB2 cost overrun and the what just happened situation hitting first quantum at Cobre Panama in Panama, to what extent or not do these things further make managements risk-averse to green-lighting new investment projects?
I think part of the challenge with these projects, and it's true beyond copper, is that these large greenfield capital spending projects deliver potentially in the future, and there's a lot of uncertainty around it. Whereas what you have now, you kind of know. So you look at the risk in putting money in the ground now, and it might be beyond your tenure, quite honestly, as a CEO. So I do think they're risk off, and I think, yes, the geopolitical risk that we're seeing is all, and the fact that, I mean, emerging markets can be challenging in terms of where to go and put capital. Now, some have performed well. Obviously, then you get things blindsided by what may have happened in Panama and others. I do think that the CEOs are looking and saying, it's tough. It's tough to make that decision. And we're generating good cash in our existing portfolio. Let's maybe just leave it there.
Okay. Well, the gold majors certainly want to become gold copper companies. To what extent or not do they risk their gold premium by moving more into the copper space? Is there still a gold premium?
It's certainly been diluting over time, and I do feel, I mean, 5 years ago you'd have argued, well, that'd be highly dilutive. But now it's a lot less so. The gap has narrowed from both sides. The other thing, of course, about getting a little bit more copper exposure is you do get that energy transition angle that gold will always tend to struggle for. So you actually attract in the investors that have a little bit more still of that ESG overlay, which has always been a bit of a challenge for gold.
Okay. Well, gold has closed at over $2,000 per ounce for about 11 straight weeks now. It's been a fantastic 3 months for physical gold, but the gold equities continue to be in a slump. Why is that, do you think?
I think there's a couple of things there. The dedicated gold investors are struggling with outflows, and quite honestly, we are seeing the mining industry generally and gold equities in particular perhaps being used as a funding source for the tech market rally that we've seen. So these are pretty liquid equities, certainly in terms of the large caps. They're used as funding sources. The other challenge is cost inflation and delivery on cost control. And that's so, while the gold equities look like they're making free cash flow, when investors look at it, it's like, well, you're just not giving us the returns that we would want.
Now, building on that, we've just come out of the 2023 results cycle, and in the gold space, at least the gold equities, there were a few real standouts, despite the fact we've been through a cycle of mega mergers and supposedly giving the market what it wants, i.e. more consolidation. Has this created companies that are perhaps too big to succeed?
I think it's hard when you've got assets across all jurisdictions and a lot of different teams. So you really have to trust your management structure at that point. I think it's why you're perhaps saying Newmont look to divest the number of assets they're looking to do. Say, well, actually, we need to simplify this portfolio a bit and say, you can create synergies, but you'll say, well, if these ones don't fit, they will take too much management time. We need to think about that in a more holistic way. Should someone else be better at operating them? The answer quite often can be yes. So I do think that focusing on core, whether it be regional or country-specific portfolios, is probably a better thing to do.
I think it's interesting the approach some of the gold companies have had to wanting to increase their copper presence. You see some of them investing in early stage juniors, which best case scenario, you're looking at 20 years before you get your first sniff of any copper. And then you've got Chinese companies like Zijin, which are investing big chunks of money in much more advanced stage projects where perhaps have a chance of getting some copper within 5 years. Does it show a lack of imagination on the part of the gold companies, or are they just really missing the picture?
I think it's interesting. I think obviously buying an existing asset can be expensive in the short term. And you would argue that Chinese companies have maybe access to more cheaper cost of capital to be able to do that. But also you look at it, and I would say the Chinese companies they do want to grow. They have a bit of a growth mentality. And that is why you're seeing, Chinese foreign investment in mines was the second highest on record last year. We think it will probably be a record this year in terms of just looking and investing in new assets. So I think this is true across many sectors. I mean, I've been saying for a while, there's many countries around the world talking about critical minerals. There's only one actually doing anything about it in terms of investment, and I would argue that's China.
And we saw another example of that last week with a Chinese company coming in over the top with a bid for a gold company in Africa, beating out a TSX-listed company who said they wouldn't respond and raise their bid. Do Western companies have to rethink their approach to not continue to be being outbid by Chinese companies?
I mean, there is a return on shareholder value, and shareholders want different things. And you could argue there's maybe different shareholders involved in that. So I think where you're seeing success for developed world gold companies is in developing assets through the pipeline. Now, I would, to your point before, maybe they do need to look at slightly nearer stage development projects and say, actually, we have the skill set to bring this to market in a better way. And that's probably the best way to approach it.
Okay. Colin, as an analyst, what do you get frustrated about in the gold and copper companies and their managements? What do you see that you think shouldn't be there? And conversely, what do you think should be there that you don't see there?
So I think there's two things I would highlight. Number one is just delivery of what they say they're going to do. And it's interesting, we've seen company after company this morning, whether it be the bulk commodities, base metals, gold companies say, we need to deliver. And it's that trust. So shareholders need to trust that when a company says it's going to do something, it's actually going to do it. And they're held accountable for that. So I think you're seeing the mindset start to change, but historically, I mean, this is why as analysts we build disruption allowances into our model, because companies have a tendency to under-deliver on what they would say. So that's one thing. The second thing I would say is back to what I mentioned before. I actually think the industry is a little bit too defensive at the moment, in that it is an industry that needs to grow, but those decisions aren't being made. So having a little bit more balance between shareholder return and growth should run a better company in the medium term.
Needs to grow. Does it need to grow a pair?
Needs to grow to meet what the world needs. If we want to decarbonize the world, we need the mining industry to do more.
Okay, well, what do you think it will take for the gold and silver equities, for the share prices to start flying again?
So I think a couple of things. I think you can look at it a couple of ways. If we see the rest of the equity market, but the point I made before, if the rest of the equity market stalls a bit, you will see money rotate back in. I think also more generally, just a couple of quarters of showing that costs can be controlled would be very helpful.
It was very noticeable in the 2023 results. There was a couple of companies that did manage to hold their ASIC more or less stable levels, but everybody else was up 10, 20%. Yeah. So it's definitely a battle on there.
It is a challenge. And I would say labour pressures in the mining industry are as acute as I've ever seen them in my career.
Okay. Finally, let's talk a little bit more about the base metals, nickel, zinc and lead. They all got creamed last year. Is that just the normal cyclicality that it affects these metals, or is there something else afoot?
The one I really want to pick up on here is nickel. Nickel, we have changed the forecast outlook for. Batteries are big. We had this big push in terms of nickel-rich batteries, and that's been reversed. You're seeing 2/3 of the Chinese battery market now is nickel-free in terms of that key electric vehicle market. So we've taken about 900,000 tonnes of nickel, a good amount, out our model through to 2030. Plus, you've seen the heavy investment in Indonesian supply, which has led to a surplus in the market. So it's natural economic conditions, but I do think, I mentioned before that you're seeing long-run price expectations generally move up, not in the case of nickel at the moment. We are looking at it and saying, well, actually, maybe this market does have a few challenges. What you need to see now is more supply cuts, and we're starting to see them. Whether we've seen enough yet, we'll wait and see.
Well, hardly a week has gone by this year without one company or another announcing it's going to mothball or put on care and maintenance a nickel operation somewhere in the world.
Yeah, and that's, again, it's part down to that, looking at medium-term pricing, saying, well, actually, it's hard. And then I would say that's a valuable strategic decision to say, actually, to my shareholders, it's worth more not extracting that mineral and selling it at today's price levels. Okay,
so looking forward to the end of the year, Colin, where are we going to be in copper, in gold, with equities?
Yeah, great question. From a commodity side, I actually think the wider economic cycle is okay. I think, as I say, copper market, this is meant to be a bad year for copper. I don't think it is anymore. So we are looking at a reasonable upside. And I think the upside in copper prices will come sooner rather than later, particularly as we come out of Lunar New Year. In terms of gold, gold's a low volatility sub-asset class in a volatile world. This is a good gold price by historical terms. So just staying at this sort of level, I don't think it's a bad thing. It's now about the companies just showing that they can manage the costs.
and get some good margin and put some cash on their balance sheets. Colin, a fascinating conversation. Thank you very much for joining us today.
Thank you.
And this is Paul Harris for Kitco Mining at the BMO Mining Metals and Critical Minerals Conference in Hollywood, Florida in the USA. If you like what you see, don't forget to subscribe.
Kitco Mining special coverage of BMO's 33rd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.